Hey guys, thanks for tuning in. So this is the first video of 2026 that we're putting out, and even though it's been only 6 weeks in this calendar year, a lot of events have happened, a lot of news flows which have potential impact on our portfolios, and that's what we're going to be talking about in this video. Before we get started, a disclaimer that this is not to be construed as investment advice. This is just my personal opinions, and it's based on also some of the interactions that we have with some of the market participants. For your own portfolio, you're advised to speak to a proper qualified investment advisor before taking any decisions. So in terms of news flow, what all has happened recently? Well, there was certainly the India-EU deal, which was pending for quite a number of years, which came through finally. I think accelerated by the pressure put by US on both India and Europe. So that was one, followed by the Union budget, which came out on the 1st of February. And immediately followed by the India-US trade deal, which was again on the cards for several months now. And finally it has come through, and everything seems positive on that front. There was also the large crash in some of the commodity prices, especially gold and silver. Silver having corrected nearly 30% from the highs in less than 2 weeks now. So what does all this mean in terms of the portfolio impact for any of us? Well, we are always firm believers of an asset allocation model. We always say that a client should have ideally some equities, fixed income, some commodity exposure, as well as towards real estate and other asset classes. But how does it have to be structured, how it has to be divided, that's a call that you and your investment advisors need to take. Broadly, how they have behaved, I think if you look at commodities, we saw a very sharp spike. Like, this is totally abnormal, the kind of moves we saw in silver and gold last year. Yes, there is certainly a usage scenario, but there was also a lot of speculation, a lot of bubble around it. So in a way, the prices having corrected is not such a bad thing. But again, I think it is best to look at these commodities as an asset allocation only. We have seen investors liquidating their fixed deposits, their mutual fund investments, and getting into silver and gold aggressively towards the end of the rally. And they must be feeling the pain of it now. But always look at these as some allocation of your portfolio which needs to go towards these assets. In terms of fixed income, what we are seeing is most of the central banks have been cutting the interest rates, because we are now in a low inflation scenario globally. And similarly in India as well. Yes, the yields have not dropped to that extent, but I think you have fairly reasonable options available even today for fixed income investing. Of course, there are the fixed deposit route, but also there are corporate bonds, well-rated corporate bonds giving you something in the range of 8.5 to 10% annualized yield, which is still a very good rate of return. If you talk about equities, global equities certainly have done much better than Indian equities in the last, say, year and a half. And the reason for that being, those markets were a bit undervalued. So the FI money which moved out of India post 2024 end has got allocated to US, China, Japan, Korea, Brazil, Argentina, etc. also have done phenomenally well during this period of time. They have delivered exceptional returns. So yes, international equities should be a part of most of the portfolios, we feel. Coming to Indian equities, what has happened? Well, we had this massive rally from 2020, early 2020 post-COVID to say end of 2024. Around September is when Nifty touched its peak of 26,300. And from there on, it's been more or less a sideways market. If you look at it broadly, within a percentage movement over that 1.5 year. But you can say that it's been mostly a sideways market. The reason for this? Well, the valuation certainly had gone quite ahead. If you look at 2024, the earnings growth of companies had slowed down. So essentially, when you're investing in equities, you're taking ownership of a business which is likely to grow. Their earnings are likely to grow at a certain pace. And even though equity will never give you linear returns, it always moves in waves. So there are always peaks and valleys which come in equity movement. And this was bound to happen at some point of time. The FI money started pulling out from mid of 2024, and then still it has not really returned back to the Indian markets. So they are doing their asset allocation across the globe. But for what it means for Indian markets, essentially, the earnings have started to come back. So that's a positive sign. The last quarter earnings were better than some of the previous quarters. And it is expected to come out better towards the next, say, 6-9 months, etc. We will see better earnings coming out. So slowly, as we get on that trajectory and the prices of the stocks have not moved, the earnings are catching up, and hence the valuations are getting fairer, to say. It's not still that we are undervalued. We are definitely slightly frothy in certain pockets, especially in mid and small caps. But having said that, we are a growing market. We are the fastest growing major economy in the world, and some premium is justified to that extent. In equities, you can essentially look at a long-term return, a more predictable return over a long term. But in the short run, it is really difficult to predict how it will be or where the markets will be 6 months from now or a year from now. That's always going to be a challenge. So ideally, what we are again saying is look at your asset allocation, think about it, and this should be basis your age, your income, your other commitments, family commitments, how much time you have towards retirement, your goals you want to accomplish, more from that perspective. Not in terms of this is the hot asset and where we want to be in. Look at what happened to Bitcoin. It's really had a massive 50% fall in just in a short few months. So again, coming back to that, I think asset allocation is the right way to go, and that's what you all need to look at. Well, if you like this content, you like these videos, we would be very happy if you could like and subscribe to our channel. We also keep putting out a lot of other posts on our various other social media like Facebook, LinkedIn, etc. So we would request you to follow us on those platforms to spread the word and help people reach out to our channel. We are very thankful that you watched this video. Happy to have you here and hope to see you again in the next one. Thanks once again.